market story by now are higher across the board. Rob, I thought these guys set it up perfectly. I think it really boils down to a simple question. Are we set up for a year-end rally or not? I think that's what our viewers want to know more than anything else. How would you answer that question?
I think it's possible. It's certainly possible. It's a seasonally strong period. We're in an environment where there's a tug of war between high interest rates, geopolitical tensions, valuations that are high, and an economy that is strong. Earnings are delivering, and a consumer that's remaining resilient. And so I certainly think that that's a possible outcome. Now, let's remember, if we were to rally back to those July highs, valuation becomes an issue again, especially if it's driven by the stocks that have the Magnificent Seven, and rates have stayed higher. You have those same tensions at that point. When we look over the last 2 years, Scott, markets haven't gone anywhere. When we look since June, markets have not gone anywhere. And yet what we're seeing is a lot of opportunity underneath the surface because of the narrowness of these stocks. So I think the answer is yes. I think you have to be a lot more selective.
Okay, so Shan, 11% of the S&P 500 reporting this week. Netflix and Tesla, those are obviously going to be critical. Yields are up a little bit today. I feel like the tug of war really exists between the bulls and the bears on the yield front in some respects. Yes, we're up a little bit today, but there still is, at least according to the bulls, the idea of this dovish Fed pivot. You had Goolsbee today from the Chicago Fed said, quote, undeniable that a slowdown in inflation is now the trend. The bear case, of course, they don't care about this alleged Fed pivot or not. They're like, well, yields are still going to remain high, and the lag effects of tightening are yet to come. Which side do you fall on?
Well, I think this short-term oscillation that we talked about last week, and Scott, we're going to get plenty of ammo from the Fed this week. We've got a lot of people out speaking. We've got Powell here in New York on Thursday. And so I think, this bull-bear tension is really about what are we talking about? Are we talking about the rest of this year? And I agree with Rob. We certainly could be setting up for the potential for a higher equity market from, between now and the end of the year. But the longer term lags of these rates, it continues to be the open question coming into 24. And how does that impact the consumer in particular? I think the other thing that you touched on is, what's happening from an exogenous perspective on the rate market right now. We were worried about U.S. debt, and we were seeing the yields were ticking up higher and higher and higher, and really didn't seem like much of a floor or ceiling, excuse me, over the last few weeks. Then we have what's obviously happened in the Middle East. You're seeing a little bit of a bid come back into the market. There could also be some additional positioning, Scott, coming into the end of the year in terms of people needing to bolster their fixed income exposure to ahead of December 31st. And so you could get a little bit of additional incremental Treasury demand. All of that, though, is inconsistent with our view of 2024, which is going to be a more challenging environment and more dispersion underneath the surface. Couldn't agree with Rob more on that particular point. There are going to be winners and losers next year in the equity market. And unlike this year, where we had a very small contingent that were leading the returns, we do expect there to be more stocks that show sort of those idiosyncratic forces in a more challenging environment.
Josh, I want to focus really on the next 2.5 months before we even sort of turn our attention to 2024, because, we've had a good year in the major averages. Under the surface, obviously, the performance of non-mega cap tech hasn't been nearly as great or carried through as much as those stocks have done. But how do you see it between now and the end of the year? 2.5 months. Are we now set up for some kind of, significant move higher?
So I think that we are, and I would tell you that, and I don't mean to start the show off disagreeing with Rob, but I don't see valuations being the problem, even if we do get back to the old highs that he sees them as. The Russell 2000 has a PE ratio of like 12 times forward earnings. The mid caps are like 13. The stocks are not expensive. The phenomenon of the Magnificent Seven is really what's making the market, like when we say the market looks like valuation might be an issue solely because of the massive outperformance and the proportion of the indices that these stocks take up. They're up huge, and they're a huge component.